When we had the crash of 87, we might have been one of the only or few growth managers that had positive performance that year, particularly with AI, are going to be winners for a long period of time. So I wouldn't take those off my list. So one of my key things is when it gets above the 50, I'll start a position. Well, first of all, you just got to find a way to keep yourself in the game. Oil is probably the key one I watch on, just because it's going to affect inflation and interest rates. We didn't do any day trading then. I don't do any day trading now. But it tells you the markets can change on a minute's notice, and you just have to be ready for it. How I get into them and how I learned to get into it with a lot of money is you start small, where a lot of people want to start big.
Hey everyone, welcome back to the TraderLion podcast, brought to you by the Ultimate Trading Guide. I'm your host, Richard Moglen, and joining us today is a really fantastic guest, Bob Fehrmann, the founder of Fehrmann Capital Management, an extremely experienced investor and growth stock trader with nearly 50 years of experience under his belt, and at his peak was part of an entity that managed over $10 billion, billion with a B. So Bob, thank you so much for joining us. Really an honor to speak with you today, and really looking forward to this conversation.
Yeah, I am also, Richard, and I appreciate the opportunity, the honor, and also want to thank you. As you know, a couple of years ago, we were going through a little personal tragedy here when you first contacted me, and I appreciate your patience. But maybe the timing's because the world certainly changed. It's the first time you reached out to me, and just a little side that from anybody who started in this business from 1980 to the current has basically been operating in an environment where interest rates are either declining. There's only been a few exceptions in that 40-year period where rates in 1980 were at 20%, got down to almost zero. So to have been operating in an environment like we are today, you pretty much have to be 70 years and older to understand what we're going through at the moment. So that might be my only edge that I offer today. So,
you've got plenty. I'm looking forward to the secrets. So no, this is perfect. And to start with, I always kind of like to lay the groundwork. Would you mind kind of diving into how you first got interested in the markets and got started on the path of being part of institutions and asset management?
Yeah, sure. Well, first of all, I've been blessed that I've been had an opportunity to work with all kinds of people. I'm not going to mention too many names because most of them they're not household names. They were more in the institutional markets. And I also was blessed by just having wonderful parents who taught me how to save money, work hard, all that kind of stuff. Anybody that was born in the 50s pretty much had the same kind of lifestyle. We all had paper routes when we were 8 or 9 years old. Parents didn't worry about us like we did with our kids. But how I really started when I was going to do my undergraduate work, because my folks didn't have the funds to pay for it, I had to get a job. Mm-hmm. So I basically, in the business school, I went to the placement office, and I really just literally went through all the ones, and I just took the one that had the highest hourly rate. And that happened to be in the business that I've been in for now 50 years. The president of the firm at that time was looking for just an assistant, but he didn't want to spend a lot of money for a full-time employee. So I was fortunate that he hired me at the wonderful rate of $2.25 an hour. So things have come a long way since then. But basically his assignment for me was really two things. They were pulling in their profit sharing, which was in those days, most of the institutional money was done by bank trust departments. And they were not happy. The firm I was with was not happy. It was an investment banking firm. Mm-hmm. So they were pulling in a profit sharing fund and they wanted to manage it internally. So that was one of my assignments. And then the other assignment I had was they were trying to create a institutional performance measurement service so that for their clients on the investment banking side, they were trying to figure out a way to measure performance for their clients because back then nobody knew how. They have a manager, they manage the assets, but they didn't have any way of evaluating and judging it. So those were my two assignments. But that's where I really got exposed to growth. I was just put on a team. The fellow, this will probably be the only name I'll mention, Richie Driehaus, because some people might know him from the
Market Wizards.
He's a good growth manager.
Yeah.
So I was 19 years old. He was 27, 28 years old. And he was I would probably call him, if he wasn't the father of momentum investing, he was really early in the game. So that's really where I got my exposure, and I just did everything that either he asked or the president of the firm asked me to do. So I really did anything, everything, charting by hand back in those days. Um,
So even back then, you're getting exposed to using charts, and from a very early point
Yeah,
as
they were
a tool.
in gathering numbers. So we would do earnings by hand, and that's where I got a little exposed to earning surprises, and we figured out ways to calculate, but it was all by hand. We started doing some of it by computers. I was probably now 20, maybe 21 at the time. I was still in school. And I remember we had key punch operators. So I'd put all the data and I'd put it on a spreadsheet, key punch operators, and they have the cards, and then we create these big, or they would create these big disks. But in Chicago at that time, there wasn't a computer that was large enough that we could get access to during the day. So we negotiated with the University of Iowa. So one of my jobs was Friday night after they got all these things there, I would drive my car all the way to Iowa, wait all weekend for them to process the data, and you'd get the big computer sheets and with our kind of rudimentary form of graphics, and would bring that back. But kind of as a side note, one of my first trades was back then you could not buy Coors beer east of the Mississippi. So I was west of the Mississippi. So I would load up my car with Coors beer, my computer work, and I could sell the Coors beer for 3 times what I paid for it when I brought it back. So
There you go. That's a good trade right there.
yeah, that was my first one.
Yeah, perfect. And walk me along kind of your career after that. How did you get into managing money yourself? And I know you partnered up with a few other individuals and to start your fund.
Yeah, those are 2 other individuals that really I was blessed to be associated. They were an in-house manager with a growth style. One of the partners had a relationship with Bill O'Neill. That's how I got involved in with all the O'Neill stuff, and we were early adopters to the daily graphs and that stuff. And he knew Bill from his experience of managing money at Bank of America. Anyways, they wanted to start their own firm. They knew me. They knew I wanted to manage money, but they also knew I knew where the money was and how to get the money. Because when I was with the first firm, we had to build our own client base and get our own clients. And so in 1985, we started with the one client. It was about 200, maybe 180 to 200 billion. So it was enough that we could kind of make a living at the time. And then and then I brought a few smaller clients with, and I'd say it was 1987. So we started in 85. It took us a while. Our performance numbers, we ranked #1. They had a 10-year record, which was also helpful. Sure. And we ranked #1 in these databases. It's percentile, so it wasn't like the #1. But the struggle we had back in those days is we were very active. So our average turnover was maybe 150% a year for an institutional one. And the sponsors of assets thought, oh, you guys are just turning the assets. And so it took us a while to really get going. Then when we had the crash of 87, we got through that. We might have been one of the only or few growth managers that had positive performance that year. We got my memories right. We were up maybe 15, 16% that year. And on the day of the crash, the chief financial officer of a company, NCR, I don't know if they were National Cash Register. So he was in my office kind of kicking the tires to make sure he wanted to give us money. So at that day, he was more interested in what was happening to his stock price than he was kicking the tires on that day. But anyways, when he left and we had dinner, he said, all right, you're hired. So we got another $150 million at that point. And then our growth just kind of took off after that point. And then we peaked out about 10 billion. The 10 billion, how we got there is we were a sub-advisor to some mutual funds. We were thinking about getting in the mutual fund business, but we didn't want to do all the administration. So we were a sub-advisor and got us to, I think it was probably almost 11 billion at its peak.
Yeah, fantastic. And what was kind of your guys' overall strategy and how were you guys all aligned on that pretty much? I mean,
yeah, we all did the same thing. And for all the clients, it was pretty much the same product. Now, there were some that were exceptions. Certain religious organizations that we manage money, say like the Archdiocese of whatever city, they would ask us to create a portfolio that would have maybe drug companies that were in the abortion, but not abortion business, but prescription for preventing abortions. They didn't want that. They didn't want any companies that developed armaments or, for nuclear and all that stuff.
Yeah.
But other than that, all clients we did the same thing for.
Yeah, perfect. And looking back on your career, I'd be interested to know, are there any kind of aha moments that really stand out where you really figured something out, or maybe it was, from a mistake that you made where you learned an important lesson? Looking back, is there anything that comes to mind where, after that moment, something really changed and you start to really figure things out?
Yeah, if we go back to the beginning, I started full time. It was either January 2nd or January 3rd, whatever that first Monday was of 1973, which turned out to be the peak of the markets. So I had to live through 73 and 74, and those markets, Richard, it was like Chinese water torture. Every day he came in the office and it was like, oh, okay, another down day. Now they didn't move with the volatility that markets are moving today.
What was the overall decline over that period
It was
in the
probably
indexes?
55% on for the indexes. One of the lessons that came out of that, I was always, I'm now 20, don't say end of 24, so I'm 22-ish, not maybe 23. I thought for sure I was going to get fired, and or the clients would fire us. But my boss explained to me, no, we're only down 31%. They think we're heroes.
That's
So
alpha.
it told me about the relative
Yeah.
game in that business. But the other lesson that came out of that is it was in October of 1974 without any notice. So here we are, basically the first year wasn't all that bad. It was only down 16%,
Mm-hmm.
which kind of relates to if we get into where we are today. It was really that second down year that the wheels really came off. It was probably down 25 to 30% in year number 2. But in October 74, with no notice, no warning, no nothing economically, the market just flipped like that. And the next 2 years, I think we were up 45%, 75, or about 60% and 76. So what it taught me, you really have to stay in the game, and you have to keep your list, and you have to find the companies that you want, and kind of like never quit, that kind of stuff. But it tells you the markets can change on a minute's notice, and you just have to be ready for it.
For sure. And apart from the people at your firm, were there any kind of resources that really informed you about how to trade? Were there any key books or other resources, or is mostly learning from your
No,
partners?
at that time, I was just learning from the people I was working with and trial and error. I had read, Jesse Livermore stuff on my own. I wasn't in 1973, 4, 5. So I didn't know who Bill O'Neill was.
Mm-hmm.
And I didn't know who all the great traders were. I was, just a young guy in the institutional investment business. If I could take a minute, I don't know if your audience, but an institutional investor, they're sponsors of large funds. So back in those days, they were pension funds, profit sharing funds, foundations, endowments, and public funds, unions, and that. And so they have these assets, and they never hire one firm to manage a piece. They kind of segregate.
Yeah.
But we were aggressive growth. This is the category that we would get stuck in. But they always would give you guidelines. And I think it was pretty much Wall Street. I'd say Wall Street's pretty much the same way. They tried to convince everybody that buy and hold's the way to do it. Nobody can time the markets. And so the sponsors of assets didn't believe that we could time the market. So they pretty much want you to be fully invested. They don't want you to have more than 5% in any one security, because that was their way of mitigating the risk. And so you had to have a minimum of 20 names, and you had to find ways to kind of minimize when you had down markets. And from the sponsor's point of view, they took care of the risk because they would do the allocation. They have some in each of these segments. And so it's, because some people say, well, why didn't you get out of the markets if you knew they were that bad? Well, you had no choice. You just had to try to find securities that would go down the least amount. Mm-hmm. So that was the environment that we all had to operate in. And I'm sorry, what was your question again?
Oh, it was trading inspirations and how you learned to trade, but it seems like it was mostly just kind of on the job and learning from
the other thing that came out of the institutional market for me is the clients would give you 3 to 5 years before they would I mean, they would judge you frequently, but they wouldn't, and most clients would give you the full 3 years to 5 years.
Mm-hmm.
So that taught me to, and it's still pretty much the style I use today, is more of a longer term nature.
Yeah.
We didn't do any day trading then. I don't do any day trading now. I probably, unless markets force me to, I don't do swing trading either. I try to find companies that I think that can last for some period of time. Now the markets will sometimes obviously dictate, but I can control that by the size and position size that I use.
Yeah, perfect. And so you would, it sounds like you'd classify yourself much more as a position trader,
Yeah,
active
clearly.
investor. Yeah.
Yep.
Perfect.
Yep.
And I wanted to lead into your knowledge a bit, and you've alluded to, the interesting environment we're in right now, where you've got interest rates and everything that's happening. Um, Thinking back in time, is there a market that this really reminds you of, or something that you're looking at as kind of a blueprint, a potential template that you're maybe kind of using as a guide during this time?
Yeah, the one I'm using right now is really my first 2 years, 73, 74. There are the similarities is in 1973, inflation was about 12%. So it was up and rising. Interest rates went up about four times, or oil prices went up about four times. The political environment was not good. That was when we had Nixon, we had Watergate. We were at war in the Middle East. So some of the macro stuff kind of lines up with where we are today, Richard. Now the big difference is we had a big bounce off the October low of last year, last year, 22. Which we didn't get in 73, 74. We got some little bounces. But that's why I posted something that is this really just a cyclical bull market in a secular bear market? And I don't know how it's going to play out, but I'm open to that possibility today, that there's more downside.
Perfect. And also looking back at your career, I'd be interested to hear, any key stories that stands out, when it comes to the 87 crash. You mentioned trading during the 90s. I'm sure you've had a lot of ups and downs over your career.
Yeah,
So, first starting about the 87 crash, because it was just kind of the anniversary of it. What do you remember about that day, and how did that kind of impact you as a trader?
Yeah, we were fortunate going into the crash. We were having one of our best years. We might have been up, for an institutional investor. It's what I did for a living would not win contests. Our objective is, and mine still today, if I can double my money every 3 to 5 years, I'm a happy camper, and the clients I have are happy campers. So we would never be winning any of these contests. I never had a up 1,000% year. Since I've had my own firm, I've had up 400 or 500%. But remember, as an institutional guy, we weren't able to use leverage. I never shorted, at least until 2000. I don't even really short today, to be honest. I may hedge, but not short. But in 1987, I think the biggest thing I got is that we had, that was when our firm really grew, because we had the performance. So I'm trying to remember. I probably remember more just the feelings I had. I was newly married, bought a house. The night of the crash, I called my wife, told her to cancel the decorator, because I had no idea where it was going to end. And that stuff. But
yeah, perfect. And thinking about particular good times, what kind of stands out? I've learned a lot from Ross Haber and some of the other people who were portfolio managers with O'Neill during the 90s, and were able to get amazing performance. How was kind of your experience during those times? Was it particular? It seemed like it was particularly good for our style of growth.
Yeah, and the 90s were perfect. It's always good to have you wind at your back. If you look at the S&P 500, I believe in 95, 96, 97, we're up 30% each of those 3 years. It was a great environment for any kind of growth stock. Probably small and mid. The riskier part of the curve was much better at that period versus large. Like today, it's pretty much a big cap environment. Small and mid are lagging. But there was a lot of small ones. I don't know if it's an interesting story or not, but one of the large clients we had, we would get together with him and his board once a year,
Mm-hmm.
and I think it was the year 1990. But he would always ask us or me, what stock would you recommend that we don't own in an institutional portfolio that you might own for yourself? And so I recommended him a little company called Silk Greenhouse,
Mm-hmm.
and they were developing artificial plants for offices, which was kind of a hit because back in those days you'd have to have a lady come in to water all your plants and stuff. And so it was about $9 a share, and it went up to maybe 35. And then I sold it, and we didn't own it for institutional clients, but our partners, we all owned it and sold it. Well, anyways, a year later, I come back and he says, how come you didn't tell me to sell it? Because it went down to 2.
Mm-hmm.
And all the other years, we just gave him an idea and then left him alone. So and he was, I'd say, some semi irritated with that because he bought it and just held it.
Right.
So the lesson I got out of that is if you ever recommend a stock to somebody, you better follow up with the sell order. So,
Yeah, for sure,
yeah.
for sure.
But there were some. Oh, go ahead.
No, I'll let you finish. Sorry.
No, I was going to say there were so many stocks back in those days to choose from, which also tells you about the environment. When there's so many things you could buy 20 names, 30 names, and they all would do well.
Yeah.
And that's not the environment we're in today.
For sure.
But,
and we had a call previously, and I kind of asked you about kind of your greatest trades, the stocks that you really remember. So I'd be interested to hear a few more of those stories. But to start with, I know you mentioned Walmart was one of the stocks that you really had success.
Yeah, that
with.
came out of well, one of the interesting things, which I think is similar, when I've looked, well, a couple things. I did a study. It's quite many years ago, but the spirit of it is still the same. Anyways, the study was that when markets are down about 8 to 9%, 78% of the time, that's it, and they don't come straight back, but they start stair-stepping up. So whenever we're in a market that's down 7, 8, 9%, kind of like where we are today, I kind of perk up and I make sure whatever it is I want to own is up to date, it's fresh, what I think, because that, the odds are just in your favor at least 3 out of 4 times that could be it. The other one I did is that when the markets are usually down around, at least the Nasdaq's down about 30%, about 75%, that's it also. So whenever I see those 2 events is when I really perk up and I really make sure my list, and that's when I'll start nibbling today. The other thing that and when I say these things, nothing in this business works 100% of the time, but they're general guides that I will use. Is that when you come out of a nasty correction like the one we had that ended in October, when at least the Nasdaq was down about 30%, that what usually bounces back first is the stuff that either got beaten down the most, and what the market gravitates to is the big cap stocks and high quality. Mm-hmm. And that's pretty much what happened this year. That's kind of what led me into what people now call the Magnificent Seven, because they were down a lot, got beat up pretty bad, but they were high quality, big cap stocks. Don't always have to be tech, because what came out of it was a lesson I learned when the markets turned in 74 and 75. Stuff like Coca-Cola that was maybe at 145 went down to $45. I mean, things just really got beat up. But that was the stuff that came back first. But after you got through that first 6 to 12-month time period, that's when the small and mid-cap stocks begin to come back. Mm-hmm. And when you think about it, Richard, it's people don't have confidence. So they kind of, when the market turns, they're going to go to the big cap and they're going to go to high quality. Once they get confidence that the economic environment is improving, then they'll start moving into the smaller mid cap. And Walmart is what came out of that. Yeah, that was for us was a big winner, late 75, early 76, maybe up 180, 200% that period.
Yeah, amazing.
Home Depot followed shortly thereafter. There was just a lot of good names. But the big, Coca-Cola came back. It might have been up 100%. Doing some of this by memory. Raytheon was a big one. General Dynamics was a big one. But they were all big cap stocks. So, so that's like in today's environment, I wasn't too surprised. I never know how far they're going to go. And I was surprised that the FANGs have moved as much as they have. So I was, fortunate, but that's what led me into those kinds of stocks.
Yeah, perfect. And I asked people in our community, for some question ideas. And before we move on, I want to dive into your individual trading style a little bit. But
Yeah.
there were some questions about, what is it like managing billions of dollars? How do you deal with the pressure that comes with that? And not many people get to experience that. So what's a little bit about
Yeah,
what that job is like?
the pressure, and it's kind of how I do it today. So when we're starting a position, I mean, for the most part, most of us are all participating in the same names.
Yeah.
And it's how I get into them and how I learned to get into it with a lot of money is you start small, where a lot of people want to start big. So any position I start today, with some exceptions, if the market's really running, I'll do it different. I still start with 1%. So in early this year, when I started with some of the, I just start with 1%. So I maybe bought 8 or 9 securities, and then I'll feed them as they work. If they don't work, I never add money unless it's working for me. Mm-hmm. But I can go from 1% to 10%, relatively short period of time. But I'm never in a hurry, Richard. I just, if I'm going to own stuff that I think can double, triple, or more over, 1 or 2 year period, I've just learned I don't need to be in a hurry. I can start with small and work to big. But that came out of my institutional experience, because in those days, particularly when we got real large, you couldn't put that money to work in a fast. I mean, there was no way I could even get to a 5% position. It would take probably, for our size, probably 2 weeks to work it in there.
Yeah, you can't just buy a breakout.
So I've carried that. Yeah, 5%. I think one of the other things we were able to convince our clients to is we didn't have to cut it. We wouldn't buy anymore at 5, but they would let us hold on to it. So if you had one that was moving, because when we first started, I always thought it was so, I'm always having to cut my winners, and when am I going to put the money back into their losing positions? So we were able to cap it at their cost value at 5, but they would let us keep it and let us run. Mm-hmm. But that took us a while to convince clients to let us do that. But how you sleep at night is you never had any huge position size. I mean, I when I hear of people saying they have 100% of their portfolio in two or three stocks, that's like, I couldn't do that. Not with any size money. And today I couldn't do that. So I control it by size.
Yeah. And one of the questions somebody wanted to hear your answer to was, what was your fund's largest ever loss? And is there an interesting story maybe there about managing risk and that type of thing?
The largest yearly loss was, the first firm I was with was being down 32% after a 2-year time period. With the firm I was with from 85 to 2007, I think we went like 12 years where we didn't lose any money at all. And then we had some years, just 1 or 2. I think our worst year was maybe down 12%.
And on individual stock, were there any kind of
individual stocks? I think that was one of the other things I learned. This was long before I knew about O'Neill and all that stuff. From when we would enter a position at 1%, if at 1% position size, if it went down 10%, we would eliminate it. Right. So we never had any gigantic losses. Now we had drawdowns from peak levels. Mm-hmm. And today, when I enter something at 1%, I'll give it 8 to 10%, and then I let it go. Mm-hmm.
Yeah, perfect. Yeah, Bob, great. I kind of want to dive in a little bit into your individual trading style now, and we talked about analyzing a chart. So if you wouldn't mind maybe bringing up your charting.
Could I just add one thing?
Please.
Yeah, my style today and to then obviously was growth, but it's more of a momentum style. So I'm looking for, I'll say, year-over-year earnings growth. So if you were to put 4 quadrants, the up and down one, I want year-over-year earning growth. And the left to right one is what we used to call earnings surprise, or people call earnings surprises today. So I want year-over-year earning growth, and I want the companies to be doing better than expected, or raising beats, whatever word you want to use to describe that. So I want growth, and I want better than expected. And I just want to own the best companies that I can find that can do that.
Yeah, perfect. So feel free to share your screen if you wouldn't mind. And yeah, to start with, if you want to focus on the fundamentals first, and kind of talk through your process there, like you just mentioned, I'd also be curious if you're always thinking about, what's the larger theme that this idea is kind of a part of, a larger kind of disruptive theme, if that's something you take into account.
On the themes.
Yeah.
I'm sorry. Yeah, well, today the theme is really the big cap tech. Well,
Hmm.
I got a few smaller ones, and I think the future is AI. If you look at the last 20 years, we had the dot com in the 90s. Probably about 2000, 2011, we had the mobile wave, I'll call it. And
Hmm.
then maybe in 2018, we had the cloud. And I think today AI is the theme. And if you can catch those themes right, you only have to, if you own 5, 10 stocks in that, you don't have to go look around much more than that to do that. So my overriding theme today is anything that has to do with AI.
And how do you pick up on that kind of trend? Is this something you're noticing that individual stocks are doing well, or are you just kind of
Yeah,
looking
you see it
around?
in individual stocks. I'm a pretty prolific reader, so I read a lot. I see a lot of research. Not that it's always right, but you begin to see it, and you can hear it. You hear it now. So
Yeah, perfect. Bob,
but
I'd love to kind of jump into a stock chart here, and maybe you could talk through a little bit about how you would position in a name, starting at 1%, where you're looking to catch it in its trends, where the moving averages
sure.
are, all of that. That'd be great.
Let's see.
Yep, it's coming up.
All right.
Perfect.
Do you want me to go through a routine first
Yeah, if
or
you
a
want to,
stock?
let's do a
Well, the
stock
screen
first.
that the screen that just popped up. Can you see the whole screen? You see?
Yeah, I can see XLC, your sector ETFs, all that. I see
Okay.
Market Smith. Yeah.
Yeah, one of the things I do this every day. I always look at the spider ETFs, and I got a few extra ones in there,
Hmm.
and then I sort it by the 50-day.
Hmm.
And I just basically want to see what's really going on, kind of at a macro level in the markets. And one of the things that I find really helpful, it tells me which areas to avoid.
Hmm.
I don't have to spend a whole lot of time on them. So, I mean, at the moment, you can see that the communication service is the only thing that's above the 50-day at the moment.
Yeah, it looks like you've added in a few ETFs that are related to themes that are going on, the cybersecurity,
Yeah.
semiconductors. You've got IPOs in there as well. So yeah,
Right.
this is a great way to look at kind of overall
Yeah. So I
what's
look
working.
at this is just one of the things I do at the end of the day. I just got kind of glance here and I just see if anything's beginning to move. I will also look at what the major components. You can kind of see what I just kind of typed in there.
Hmm.
Which so I'll have that on most of the groups, so I can see what's in there. So, my adult children, they're all in the financial business.
Hmm.
So in some cases, that's all we can use is ETFs because of the pre-clearance and other
Restrictions.
issues.
Yeah.
I can't use individual stocks. So, if I really want to have some kind of exposure for them for in Meta and Google, I would just use this ETF for them.
Perfect. And yeah, that's great. And looking at kind of an individual stock, maybe taking a trade that you've made previously this year. Um, could you kind of walk through how you positioned to that name over time as it kind of worked for you, and maybe your typical process for positioning in a name where you're not just able to buy, the breakout, you're kind of building into it as it works for you.
Sure.
Great. So here's Meta.
Yeah. Okay. What I love to use, or I primarily use moving average, Richard,
Hmm.
and the on the daily I use right now all you see on this one is the 50 and the 200.
Hmm.
That's the red and the black. Uh, but on the daily I'll use the 21, the 50, and the 200. When the
Hmm.
markets start correcting like they have been here, I get rid of the 21. I'm a visual kind of guy, so I can just quickly look at this and say, is it above the 50 or below the 50? Can you see the whole exhibit?
Yeah.
Okay, just on my screen. I got to move it a little bit. Is that okay if I move it like that?
Yeah, that's fine.
Okay. Then most of the buy to sell decisions, I'll either work off the weekly or the monthly. On the weekly, I just use the 10 and the 30 week, and on the monthly chart, I'll use the excuse me, the usually 18 months or 20 months. I kind of futz around with both of them. So on this one happens to be Meta. I was pretty much all cash going in there, but when you see where I got the green little arrow right here,
Hmm.
when things begin to get above the 50 there, that's where I'll start a 1% position.
Hmm.
And and Meta was one of the early ones that announced cost cutting. It quite hadn't come through. You can see the earnings numbers weren't all that great yet.
Hmm.
But so it's not always just an earnings story. If they're restructuring or reducing costs, which I thought would then flow through to earnings, which they have. Um, so I start with a 1% position at sometime in January. Let me see what it is. Yep, in January. And then as long as it's working, I keep building it. So when I got to the 200, I might have had a 2% position. So I'm not like large.
Hmm.
I'm just working my way in here. And then it digested it after the earnings gap up. And then in that period, when it kind of broke out there, I'm
Hmm.
normally not a breakout buyer, but it was strong after that. It got going again.
Hmm.
I added there. And then probably when it got up into I'd say this range here, it was probably about an 8% position for me, which in this environment's pretty large for me.
Hmm. Hmm.
So one of my key things is when it gets above the 50, I'll start a position. And then, the question is, well, what happens if it didn't work? I kind of I'll give it like 5% around the moving average because sometimes stocks they what we used to call trapezing around the moving average.
Hmm.
And so I'll give it about a 5% movement up and or below the moving average.
And as you're adding to the position to build it up either to that 2% or later on as you build it up to 8%, are you using shorter term price patterns, or it's really just kind of as it's making progress for you, you're slowly adding?
If it's moving up and if it's moving up, I'll add.
Hmm.
Um, I'd probably say most of my decisions are on moving averages. Sometimes I'll trade trend lines, breakouts of resistance. Usually by the time a stock breaks out in the O'Neill methodology,
Hmm.
by that time I'll probably have pretty close to a full position for me. Um,
So you're looking to establish the position closer to the moving averages as the stock is kind of curling up
yeah,
the
and that's one of
base.
the things. When we were in the institutional business, we're the ones buying. That's what creates the base,
Right.
and so that's kind of how I was trained in doing it. So I was never a breakout. I mean, I didn't even know what breakouts were when we were on the institutional side, and I didn't use volume because those days I really didn't care what some other firm was doing in terms of their buying. We would just, if the fundamentals were right, and I look at a chart, and if it was above the moving average, we would just start positions in it. And as long as it was working, we would just keep filling it until it got to our full position, which was 5% back then. For me today, pretty much a full position is 10, and
Hmm.
then I'll just let it do its own thing. So if we had an ideal environment, I would probably have 10 positions with 10% in each of them.
Perfect. And
But
you touched on it before you brought up a chart, but would you mind kind of walking through the data points that you look at to judge the fundamentals of the company? So say you bring up a fresh chart, what are you looking at to kind of analyze the stock holistically?
I'm looking for stuff that's growing, not historical, but these are earnings estimates for a quarter and a year.
Hmm.
And then I like the acceleration, which
Hmm.
is the yes, no. And then you see the earnings surprise.
Hmm.
And then are they accelerating their sales?
Perfect. So
And
you're looking for growth, especially on,
yeah,
on a yearly
yeah,
horizon, and
yeah.
yeah.
And so I run the screen. So I'll do this. I'll do it on my watch list. But I'm going to move and try positions that are got the strong earnings, the sales. If you look above, see where my marker is here.
Yeah, the
Yeah,
gross margin.
I love it when companies like this have that kind of margin improvement. Let me just show you, see what's happened to Tesla.
Yeah, so this is declining a little
Yeah,
bit. Yeah.
yeah, yeah. Tesla, I think, is kind of toast for a while. I do not own that anymore. I did for a while, but that one's gone. Um,
Does it depend kind of what business they're in, that the metric you look for, or are you always looking
yeah,
for above a
it
certain
is.
number?
It's not the overriding one for me is the earnings momentum.
Yeah.
the surprise and the sales. But margins today are important, and I think that's one of the negative parts of Tesla's story today.
Yeah.
So it's not all the rest of my own in let's see, the Meta and Google are my two largest positions at 5%.
Mm-hmm.
Apple, Microsoft are probably 1, maybe 2%. Nvidia, I've cut back on Nvidia. It's not, I don't know. Can you see it now?
Yes.
Okay.
Yep.
Yeah, Nvidia's just struggling for a while here, and when they start to break below the 50, I'll keep this position because I got it way back in here.
Mm-hmm.
But it's gone from about a 7-8% position, and I've cut it back to about 2 or 3, and it's mainly because of this kind of break. It's just digesting, so I still think it's. I mean, this happens to stocks a lot, Richard. When they've had this kind of move,
Right.
this is the normal. They're going to digest. The comparisons is probably one of the things that's going to be challenging for Nvidia going forward. At least if we get a year, I mean, let's see, going back. Well, this will be the hard one. So maybe a year from now, it's going to be tough for them to produce these kind of numbers.
Mm-hmm.
I mean, it's just what happens.
And another question. Yeah, go ahead. Sorry, let me go for
No, I said I just put a green arrow here. I always just put an arrow on my charts where I start a position, and then but I put a little note here. I wasn't sure if this was going to be an exhaustion gap or a breakout gap,
Right.
and it's still unclear. I mean, because it wouldn't surprise me this could pull all the way down to the 200 day again.
Yeah, and will you
if
kind of
if the markets really get challenging, I mean, right now I'm expecting that there's a probably 50-50 chance that the market could have a year-end rally. It's kind of what I'm trying to position for, assuming that it happens. But if we decide to go into, not we, but if we go into a recession, war breaks out, all the macro stuff that folks are concerned about, this easily could test that could go all the way down to 300.
Mm-hmm.
Yeah.
And could you kind of walk through your process for selling a position that you own? So you caught the turn on these really nicely. How did you go about trimming back from an 8% position to now a 5? And it seems like you're kind of sitting through the digestion and trying to hold a piece. But if it further breaks down, I imagine you'd kind of let stuff go incrementally.
I'll probably keep at least a 1% position in here. For me, it would probably have to break the 200,
Mm-hmm.
But see, I still have cushion, and I don't mind giving up part of that cushion because I'd like to see. For me, if I have, we used to call them placeholders, which means we'd have a 1% position in it. Mm-hmm. And sometimes, as long as it wasn't 10% below our cost, but if I still got some kind of cushion in it, it really keeps me focused on that stock. Whereas if you got if it just moves over to another list, in my past, I would miss so many things that would move just because I wasn't focused on it enough. So this would have to really get ugly for me to get rid of the 1% position. Mm-hmm. But most of my moves are when they have breaks of the 50, when I start cutting back.
Gotcha.
For me, yep. So you can see how it just trended real nicely for me, and then it started having a little character change here, and it just so I lighten up. But I don't eliminate. It takes a lot for me to eliminate. Let's put it this way: from I will never 1% position. I will never let it get below 10%. I'll give up that. But once I got this kind of cushion, I try to hang in there as long as I can because I'm really trying to position myself for a stock that can have a 2, 3, 4, 500% move. And for me, what works best is to stay involved in some fashion.
Yep. Perfect. And would you mind bringing up Google and kind of walking through maybe kind of an if then scenario where what would have to happen for you to cut that one back? I assume the 50 days, another guardrail, and then maybe even add to it in the future.
This one's been a little messier.
Yeah.
You can see it certainly wasn't as clean as the video was. Mm-hmm. So this one's been hard. I've never really gotten it much above I think 4 or 5% position was my biggest. I mean, this one I really like long term. Particularly with AI. It's had some lawsuits against it. There's talk about maybe breaking up the company. I think it might be worth more if they broke it up. But yeah, as long as it's trending here, I mean, here's where I kind of cut it back a little bit, but I still have, let me just take a look. Yeah, I have 2% still left in it. And that's that I can hang in, as a position trader, I can hang in there much longer than most people. Now, if I had a 10, 15, 20%, there's no way I could do that
Yep.
with my style. It's just not possible. I mean, then I couldn't sleep at night and I'd probably be losing money. But you can see it's got some nice, I mean, the RS is, which is important to what I do also. I don't want to, we haven't talked about it, but I mean, this is, yeah, I mean, so this has got some nice stuff going for it.
Yeah, for sure.
Yeah, you got earnings in one day, so I
See
don't
what
know.
happens.
Yeah, I'll wait to see what happens.
Yeah, perfect. And would you mind bringing up a weekly and even a monthly chart and kind of walking through what you hope to see on those for both kind of the setup as well as um,
Yes. I'm
some
sorry.
kind of distribution signs? Because I know you mentioned for a lot of these names we're still below those pre bear market highs. I know you've been watching that.
Yeah. Is there a particular one you want on the?
Oh, whatever you prefer.
You want me to use the index?
Yeah, that's great.
I'll use the tradable ETFs, the Qs.
Hmm.
Yep. Well, you can see it peaked in 2021.
Hmm.
I can just see. I gotta get a little closer to the chart. My eyes aren't as good as they used to be. Um, yeah. So what I'm looking for is, we have the 2021 peak. Right now, the Qs are slightly below the 10, really just sitting on the 30.
Hmm.
And we haven't broken out above the July high.
Hmm.
So I'm not sure at the moment. That's why I'm still very cautious, because we're just kind of teetering on the moving averages on the weekly. We still haven't gotten above the 21 highs. And for growth really peaked. Our kind of growth, or at least the real aggressive stuff, really peaked in February of 2021.
Hmm. Yeah.
The index is in late 21. I think the S&P 500 might have been early 2022 has peaked. So you can just see we've just been kind of floating around here for nearly 2 years. So the big question is there enough momentum at some point, either economically or the companies come through with their earnings, to really start a new bull market, or are we just going to roll over and test these lows again back in October?
Yeah.
So that's what I want, or watch. Let's see but when you look at the long term, I mean, this still doesn't look on a monthly now. Can you see it all, Richard?
Yeah. Yeah.
Okay. I mean, this is pretty much like a cup and handle. So I mean, it's
Potential turning point. Yeah.
yeah, right there.
Yeah.
So I I know for sure I cannot predict the future, but that's why I always want to look at the left part of the chart just to see where we are and where we've come from.
Hmm.
So for me right now, everything's really kind of unclear. We still haven't cleared these highs. We haven't cleared the July highs. And it's just a matter of what the market decides it wants to do. So for me, it's just not a time to be risky.
Hmm.
Um, but it's rare. It's kind of rare for me to ever be 100% cash. It has to be really bad. I always keep some exposure. I mean, even today, I'm probably 20% long. I got a little bit of a hedge on some of it, but it's not a risk on environment for my style. Yep.
And outside of taking a look at the indexes and I assume individual names and how they're acting, are there any market indicators that you like to refer to get a sense of the health of the market? And also, I was going to ask about kind of any macro factors that you take into account, interest rates, what the Fed's doing, all of that.
Yeah, on the macro, I think the three things is I primarily look at the 10-year, the
Hmm.
dollar, and oil. And until those start coming down, I think it's just a headwind for the markets. It's going to be extremely hard to do that. I think right now, I think for me, probably oil is probably the key one I watch on, just because it's going to affect inflation and interest rates.
Hmm.
And if oil, let's see, it's starting to come up. It's peak a little bit. I think it just got extended. So I don't know if, my current view today is this is just a normal little pullback. But if this can start trending down, I think then stocks can move forward. How much they're going to move forward, I think right now is the big question.
Hmm.
Because interest rates are going to have to come down a lot, and then if they come down, are they really coming down because we're getting into an easy money environment, or are they coming down because markets are forecasting a recession? And then that would not be good for stocks. It's kind of like the 73, 74 market. The word they coined back then was stagflation,
Hmm.
where you had higher inflation, lower growth. Um, so there's a chance we could be in that kind of environment today. But the three main ones, to answer your question on the macro, is just oil, the 10-year, and the dollar.
Hmm.
And until those move lower, it'll be a struggle for stocks.
And do you look at any breadth indicators or anything like that, or
Yeah, I
not
mean,
so
I'm
much?
aware of them, and new highs versus new lows. I mean, those numbers are all disgusting at them, or bad, not good. Uh, New highs, new lows, the breadth. I look at those, but I don't. To me, it's more when I'm looking at price is about the only thing I really care about.
Hmm.
After the fundamentals, I mean, price is what's going to drive everything.
Hmm.
So I'm aware of those. I'm aware of sentiment, but they really don't impact my decision making.
Yeah, perfect. Yeah, great. So I think that's most of what I want to ask on the market there. People are interested. I know we talked previously about you want to talk a little bit about um, when things are coming out of a correction, kind of your experience, how to handle markets when they're just coming out of a correction, finding the leaders, that type of thing. Do you want to touch on that a little bit?
Sure. Yeah. When well, the first thing I look for is the market down 8 to 9%, which, let's see, where are they today? Oops.
They're close, I think, if not there.
Yeah, it was almost pushing 9 earlier in the day, but let me just see how it finished.
Hmm.
All right, so it's 8.3% on the Qs. All right, so this is if you play the odds at this point, at least when I did the study before, and like I said, I have no idea if it's correct anymore. It's been so long since I did it, but I think the spirit's still there. Um, you should have your watch list together, or pick an ETF that's your favorite ETF to begin to think about waiting. And the beauty today with no commissions, I mean, you could buy 10 shares of this if you want to just get some exposure if you're coming from a 100% cash position. But I think now is the time to at least have your list together of what you would like to buy. And I think it's probably appropriate to nibble, and then you just give it your 3, 5% or whatever you feel comfortable with. But if you just do a 1% size, you're not going to get hurt if the market decides that this isn't it and it's going to be a nasty one. Um, but I would still gravitate towards what's working, which
Hmm.
would be the Magnificent Seven, some large ones. I mean, let's see, another one that's I do own. It's not a Magnificent Seven is Lilly.
Hmm.
You can see it's behaved well, but this thing see how it pulls back.
Hmm.
So for me, these are pullback. These are ads for me
Hmm.
down here. Uh, I did add a few shares today too on this pullback, and I'll cut it if it breaks below the 50.
Where did you start your position on this one? And were you watching
Medicare.
kind of nice? Were you watching the kind of new diabetes drug that they're
Yeah,
using? Yeah.
that and one of my it wasn't my first client, but one of my first top 10 was Eli Lilly
Hmm.
clients from old days. I'm always sentimental to clients that gave me money or products. Um, I mean, I've been an Apple user just from almost, I don't know, 40. I was the only partner in the firm that used Apple. Everybody else used Microsoft or OS products, just because Apple was a good stock for me. So, but,
Hmm.
but yeah, it's partly the drug. You can see the earnings numbers are strong. Back to
Hmm.
the gross margins is what I like that. Got a good RS. It pretty much behaves the moving averages, at least it has this year.
Hmm.
But it likes to pull back like this.
Yeah.
It's just one of its characteristics. I think it's a good long term. It's been pretty good long term hold for me. It's not a fast mover,
Hmm.
I mean, so it's I don't think the odds of this doubling or tripling are not high, but it's one that you can hold a decent position in, and you don't have to worry about waking up in the morning and finding it down 20%.
That's always good. Yeah. Um, you started talking a little bit about your routine previously, but that's kind of my favorite thing to ask people is kind of what they do to set themselves up for success and to build that focus list so that they're ready to go if the markets really turn and gain speed. So what's kind of your overall process and maybe some key screens or things that you look at to inform you about the market, build that focus list and narrow it down to the best.
Okay, let's see if I find it. The first one I have is I call it an institutional favorite. I don't know if you can see all those names, but maybe
Yeah.
I could. Is that better?
Yeah, that's good.
They're not charts, but this is something I've been using really. My partners, or not my partners, but my employers back in 73, 74, we wanted to, we put together a list of names that we thought institutional growth managers would want to own.
Hmm.
And obviously it's changed over the time. But today, if I were still in the institutional fund manager list, these would be the names I would always want to follow and watch. Doesn't mean I'm going to own them all. And then when I've done the research on, some of the big mutual growth funds, the Fidelities and others of the world, you can go through and you can see what their top 10 holdings are.
Yeah.
So I know they either have to build positions or for the most part, they're going to try to support them. So this is one of my just kind of go-to lists, particularly if you're coming out of a correction. Now I don't own all these. Some of these are not in really good spots. This is showing.
Hmm.
And almost anybody can do it. And I don't change this list, Richard, very often.
Hmm.
I mean, only two names I can think of that I've eliminated was Baba and Baidu,
Hmm.
because those were institutional favorites for long periods, or at least for a few years.
Hmm.
Um, and then
Adobe's an interesting one too because it's got that AI theme going for it as well, and
yeah,
their margins are quite impressive as well.
I'm sorry, which one?
Adobe, the one you have right
Yeah,
here. Yeah.
yeah, yeah. That's it's on my list. I don't own that one at the moment, but all right. So I start. I always review the ETF sectors. I always look at this to see if any of them are in a viable position.
Hmm.
I think I posted this once before. I like to look at,
Liquid names.
yeah, the big ones. What I've experienced is that companies that once they reach about 100 billion in capitalization, they're survivors.
Hmm.
Now, it's not always entirely true. I think Enron made it to 100 billion, and obviously they failed. But you can see the names on here. So people are looking for a shopping list, particularly in today's world. As I mentioned earlier, when you first come out of a nasty correction like the one we last came out of, where the Nasdaq was down 30+%, what usually comes out first will be the big cap and high quality. And this is where I would look, because they got the size, they got survivorship. Doesn't mean I would buy some of these.
Hmm.
Some of these names I'm not sure I've ever owned. I mean, Coca-Cola, I don't think I've owned for 30 years. But so that's where I go. And then did you want to go through more screens? I
Yeah.
don't want to overdo it.
Yeah, if you have maybe 2 to 3 key screens that you think people would find value in, and maybe show the criteria a little bit, I think people would find
Okay.
that helpful.
If I open that, can you?
Yep.
So
Yep. So again, that EPS acceleration seems quite important for you. So and margin acceleration here. That's
yeah.
interesting.
Yep. Here's one of my other ones. Let's see the best.
Yeah. So looking for
Right,
40% EPS
all right.
annual growth.
Yeah. So I was just looking for a little, stuff that's over $25. I want earnings growth of 40%.
Mm-hmm.
And this varies. I mean, sometimes I only get 2 or 3 names. So it tells you that there's some, let me, oh, can you see all those names? There's
Yep.
a lot on this list.
Yep.
And then here I have it sorted by industry group first because obviously that's important.
Mm-hmm.
Because usually if it's not in the top 40, that's probably one of my other criteria. I guess we didn't talk about.
Mm-hmm.
I know it's just going to struggle. So I sort this one by industry group, and then I go over here by quarterly earnings,
Mm-hmm.
and then you just go through each one, and you just decide, is that in a viable position? And to me, it's just basing and kind of futzing around at the moment. Uh, I don't know how many you want to go through.
No, no specific number, but just talking about the process. So you're going through all these
Yep.
names, and then you maybe put the best of the best into a separate watch list. Do you do anything more to kind of separate the best, find the highest quality
Yeah,
ones
I
that
try.
you?
I try to keep my what I've learned for me, anyways, Richard. I try to keep my watch list as small as possible.
Yeah.
I may, on the weekend, I'll probably screen just about everything that's out there.
Mm-hmm.
I do have the S&P 500. I have all 500 stocks, and so I'll just quickly go through them. And that's why when I change my charts, particularly on the weekend, I'll just have one moving average. I just want because I can do it real fast. I can say, "Oh, is it above or below?" And if it's below, but my overall watch list will rarely have more than 40 names on it.
Mm-hmm.
Um, and I'll change it whenever it needs to be changed. Some things will fall off, some will add. But I'll screen just about everything once a week.
And then
And and the first question I ask is, what areas do I just don't want to have anything to do with? And that's why I use the ETFs because it just slows or speeds up the process.
mm-hmm.
Um, the other one is just Bill O'Neill's list.
Mm-hmm. And then on a daily basis, are you doing anything different? Are you doing kind of more of the same, or are you just kind of reviewing those 40
No,
stocks and running a subset?
on a daily basis, I'll screen ETFs. I screen what I own, and I'll screen my watch list, and that's really all I do. Because see, I'm not trying to catch every little movement or every little tick. I'm just trying to find positions that I can build.
Mm-hmm.
And if I find things I can build, I'll kick something out before I add something. So I'm not going to go, from I think in the early part of the year, I was up to 18 names, which is a
Mm-hmm.
lot for me. But when I start coming out of a correction, I'll just take 1 or 2% positions, and I'll just keep adding names, and then I'll see what works and what doesn't work. So that I can capture most of the stuff that moves that's leading out when you do it with small position size. Um, and then it's just a matter of adding and subtracting. But in an ideal world, I'd love to just have the 10 names and keep adding and subtracting to them and kind of trimming and pruning and adding to
Mm-hmm.
those. Um, but on the weekend I'll screen everything, but during the week it's usually just my holdings, my watch list, and the ETFs. Keep it simple and short.
Yeah, perfect. And the question I get often, and that I see a lot of traders ask, is how to get from the 40 names or the 100 names, whatever's on their kind of wider watch list. Do you have any kind of guidelines for going from that subset to a final kind of buy list of the highest quality names? Any kind of guidelines that you think through, or things that you really focus on to focus on the best of the best?
Yeah, if it's well, in terms of the moving average, if it's below the 50, I'll ignore it. And when
Yeah.
I say below the 50, more mainly because I'm a visual person. When I let's see if I can find one for you. 50, 50. Well, this isn't something I would be buying, but if it's 3% below the 50, I'll keep it on a watch list. This is not one I'm interested in, so I picked a bad example, but it's below. But if it's within 5% of that moving average, anything below 5%, I don't have any interest in. But if it's something like Amazon that's 3 to 5% below the average, I'll keep it on my watch list. Okay,
Hmm.
I wouldn't add anything here until it gets above there. But I don't. But it's something I want to keep and watch. I mean, they got earnings in 3 days, so that this could move if they come out with some great numbers,
Hmm.
and the market behaves itself. But I think the key to do is if it's above the moving average, then it's just a function that doesn't have the characteristics that you want. I mean, if they got the strong earnings and their sales are growing and they got the gross margins, for me, that's enough for me to get one started.
Yeah, perfect. And just taking a step back as we've been going through these charts and everything, you keep things very simple. Is it above or below the moving average? what are the numbers saying? You're not adding all this complexity. Is that something that you've kind of learned over time? Keep it as simple as possible.
Yeah, I mean, if you saw my charts 20 or 30 years ago, I mean, I had everything, and I had Fibonacci stuff and all that. And it, again, for some people, it's helpful. I don't want to knock anybody that uses that. Everybody has to find their own methodology, what works. And simples work. That's just worked for me. And you can still make a lot of money just buying stuff that's over the 50. You can do small size and build. You don't have to own just two or three names.
Yeah.
I mean, I know that works for some people, but for some of you in your audience, if they're struggling, my guess is it's probably due to position size. And I just, that's what I've kind of taught my kids and the ones I teach, to start small, or just start with an ETF if you're really new at it. Mm-hmm. And until you develop some experience and you learn how markets move and how price moves. And particularly in a world with no commissions, I mean, you don't have to worry about it. Just buy, even if you're just buying one share, just so you can learn how price moves and how you handle it.
Yeah, perfect. Is there anything with regards to charting that you want to go over? I've just got some kind of psychology and mindset questions now, and then that's kind of my focus.
The only thing I would say is when the markets are down 8 to 9%, you pay attention. It doesn't mean it's an automatic buy signal. The markets go down 30%, pay more attention. Yeah. Because usually what happens when markets are there and fear starts setting in, either people are bailing out at, probably when it's too late, or they're too fearful to get in. I mean, we're all going to make mistakes. I mean, I still make mistakes at this day, but the easiest way to control it is with position size. But you got to give things some room to move. You got to let them price breathe a little bit. And if if you got your stops too tight, you're just going to get stopped all the time. And so that way with size, like when I start with one position, I mean, I can give it 10%. I mean, you won't even notice it in the portfolio. I mean, if you did 10 names and each one got stopped out at 10%, I mean, you only lost 1% of the value of your portfolio. So you're still in the game.
Right.
And then when the ones that work, you want to feed, just keep feeding them. And then, you could stop at whatever level. In my case, it's probably 10 to 12% when I stop. But if you want to push it to 20 at that point, push it as far as you want.
Perfect. Yeah, no, the super important reminders. And that kind of falls along with where I wanted to go. Given the career that you've had, nearly 50 years in the market, what do you think are some important principles that traders need to follow to, be in the markets for decades and get the benefit of compounding their capital through all the different bull markets that they'll experience?
Yeah, well, first of all, you just got to find a way to keep yourself in the game. I think, our capitalistic system, I mean, where wealth is really created, I think, there is no better vehicle than the stock market. You got liquidity. I mean, that's one of the things I still love about our business. I mean, if you want to go 100% cash, within minutes, I can be 100% cash. Yeah. And there aren't many other investment vehicles you can do that. I've had some money in real estate, mostly in the homes I have, but friends that are in real estate, when the market turns against those people, there's no buyers on the other side. It's pretty hard to liquidate yourself. So I mean, I just love what we do and the opportunities are there, but you just have to find a way to get involved. And I think you can do that with the size, develop a list. And you kind of, you have to work at it. It's not easy. And you have to find your own style, methodology. I don't know if I'm answering your question, but
no, I think that's good. And leaning again on your experience, and this is something that every trader is going to go through multiple times. How do you kind of personally handle a period where you're not particularly trading well? Things aren't really working. You're managing risk, but getting stopped out a lot. How do you handle kind of those drawdowns, both in your financial capital as well as the psychological hit that sometimes those periods cause?
Yeah, we all. I mean, well, I'll speak for myself. I mean, I don't hit home runs all the time, and I strike out as much as anybody else. The emotional part I can control just by size, as we've discussed. On kind of outside of trading, I meditate. I don't know if that's the direction you're.
No, that's perfect. That's
Okay.
perfect.
Okay. Yeah, you have to find ways to kind of relieve whatever stress that you're creating, no matter you're trading, you're investing, you're running a company. You have to do that. I've been meditating since I was 30, so for 42 years I've been meditating. And meditating is not some mystical thing where you're sitting around, everybody's saying Om and you got your fingers attached. It's really just trying to silence and get your mind to focus on one thing.
Hmm.
And in the beginning, it's hard. The fellow that taught me how to meditate. So we're going to do this for 30 minutes. And so, you close your eyes and you focus on your breathing. In that case, you were given a mantra, which is basically just a word that you repeat. But I all of a sudden open up my eyes and I look at my watch and it's like, holy, only 2 minutes have gone by. But for over time, Richard, you'll find that you're really just trying to silence your mind to be just focused on one thought, and it can be relaxing. You might fall asleep. That just basically is saying that your body's tired and it wants to rest. But for me, that's really helped. Being outside in nature. Um, our family's outdoor people, so I love being outside. I like to exercise. So there's any kind of activity you can do that can get you away from the screen and the pressure can do that. But in terms of the meditating I found has been just extremely beneficial. You kind of walk away from the world. Plus, you also have to learn to live with your own thoughts because our minds are always traveling. So you try to spend 30 minutes in silence, and you get to know yourself, and you get to learn yourself pretty much because you'll see all those or hear all those thoughts going on in your head, and all you're really trying to do is just slow it down. So.
Perfect. And I know you're an avid golfer, so I wanted to make sure I asked a question about that. How do you think sports and it's also of course something that you get outside, you spend time with friends, family, all that.
Mhm.
How do you think sports and this particularly golf, impact your trading performance and also just kind of impact your life?
Yeah, I think any outside activity really helps. When I'm struggling with trading, well, I'll relate it back to golf. One of my objectives is to shoot my age.
Hmm.
So when I was 71, my low score was 75. This year, my low score is 75. So I'm close, but I don't do it as frequently as my early days. 75 used to be a bad score for me, but as I get older, I struggle. So if I can't shoot better than 75, I either got to really stay healthy so that in 3 years from now, when I am 75, hopefully I can shoot that number again. But if I want to, at this stage, get better, you have to go really back to the real simple, basic things. So
Yeah.
what I'm going to try to work on next year is I'll first start on the greens because that's where you lose it. And so I will probably practice and practice until I don't three putt probably from 30 feet. So I'll hit 30-foot putts. And then I'll move back to maybe 50 yards from the green and get that done. And what that relates the same thing to trading. So when you're struggling with trading, you just have to really not only go back to basics, just try to get down to the most minute thing you can do. If it means just trading one share in one stock or one ETF until you can get your confidence and all that back. So for golf, that's what I'll do. But when I struggle with trading, I do the same thing. I may just go to, if not all cash, a little bit, and then just pick away small and just work with a handful of stocks because we all struggle at times. And sometimes it may not be the process, it's just the market. And we all try to fight that. And my adult children are the same way. They think trading is something that you have to do every single day.
Yeah.
And if you're a day trader or you need the cash flow because that's how you have to pay your bills, that's not the game I participate in. So you just have to find that style and what works for you. But yeah, I think sports. I like to fish also. I mean, they're all fishing. You have to be patient. I mean, just because I got the lure in the water doesn't mean the fish always bite. And trading's the same way. Sometimes stocks. I remember as a side in 2004, Apple was trying to work its way out. They came out with the iPod. I think that's about the time Jobs probably came back to the company, somewhere in that range. Well, we tried that stock 3 times and got stopped out 3 times. On the fourth time, we tried it, and it might have went up about 480% on the fourth try.
Perfect. Yeah,
So
and
got to hang in there. So.
yeah, great.
And then I like to read. There's, you can read books on everything. I like the trading books, but there's one I just recently finished called Outliers.
I just read that
I
as
don't know
well.
if you're familiar with it. Yeah, yeah. And it's, about some of the things with success. But or if you try something 10,000, if you really want to master it, you got to try it 10,000 times. And so I think folks can read books that'll be helpful, either psychology, meditation. I mean, today with Google and YouTube and all that stuff, you can just kind of fire up and learn anything you want to. So.
Yeah. And one last question,
Sure.
and I see the golf club behind you. I also see the guitar.
Yeah, the last time I did that, it slipped and put it right through the roof. So my wife, or not through the roof, through the back wall. So.
Yeah. But yeah, going back to balance, golf, it seems like music is a big part of it as well. How important is that, relating it back to longevity? To do this for decades and manage the stress, it seems like balance overall is really important.
Yeah, I love music. When I was a young boy, I thought I was going to be a rock star. We play guitar. We all had our little garage bands. Remember, I grew up in the '60s, so I saw one of Mike Webster's questions.
Yeah.
I like Derek and the Dominoes. Cream was also good, but Derek and the Dominoes, the rhythm section was outstanding. But I was invited to a club it's called Arlington Heights. It was called the Cellar, which is a northern suburb of Chicago. And I was 14, and everybody said, "Oh, you got to see this kid that just moved into town to play guitar." And when I saw him play, I just said, "Man, I got to find something else to do." It turned out to be Ted Nugent. He had just moved into town, so he was 3 years older, and I was just amazed at what he could do on a guitar at that time. So, but I still played it. I still putz around with it. But football was my sport when I was younger. So.
Yeah, perfect. And do you have any favorite quotes that can relate to trade, or it doesn't have to be a direct relation to trading, but any quotes that you find particularly meaningful that people out there might find value in?
A single quote?
Anything that comes to mind. It can be a series of them, anything like that. Not to put you on the
No,
spot here, but
no, I haven't given that a thought. A quote. There's so many, but you caught me off guard on that one.
no problem. We can come back to it. My last favorite wrap-up question is, if you were talking to yourself at 20 years old, 30 years old, you're just getting into this business, what advice would you kind of give yourself to have a successful career, to pick this up quickly, and to just to kind of get to where you want to be as quickly as possible?
Yeah, if I had any advice to give my 20-year-old self, would be patient, patient and flexible. I was always in a hurry, and I was probably much more rigid when I was 20. I thought that if you had this formula, or if it was, for me it was growth style, that if it had certain characteristics, the price should always go up. And but it doesn't work that way. So the two things is patience and flexibility.
Perfect. Well, Bob, thank you so much again for your time. I think, specifically about trading, the stuff you said about position sizing, I think really stood out to me, your advice on that. So I really appreciate you coming on here and sharing your expertise. So thank you so much. And to everybody watching, I hope you enjoyed it. Please leave a like down below, subscribe if you're new to the channel. And Bob, any last bits of wisdom that you want to share, some secrets?
Yeah, I would just say in this environment, be patient, be careful. If you're gonna early in the correct and early after any kind of bear market, gravitate towards big in quality. That seems to have worked over all the bear markets. If this turns out to be more of a bullish market, and we get above the moving averages and then above the July high, then I would shift and look more at the small and mid cap stocks, because you're going to get some amazing winners out of that area. But we got to get into, you got to get through this phase we're in now before the small and mid are gonna come back. But I would keep my eye on it so that if this turns out to be a really full-fledged bull market, gravitate to the small. I think the big cap tech stocks, particularly with AI, are going to be winners for a long period of time. So I wouldn't take those off my list, but I would certainly add the small to mid if we get into a bull market.
Yeah, those can be kind of
those will move.
Yeah.
But that's usually the second phase of the bull market. Usually the first year is the big, high quality. Second, third year will be small and mid.
There you go. That's a golden nugget right there to end it off. So, Bob, again, thank you so much to everybody watching.
Yeah, thank you, and I appreciate your patience.
Yeah, of course. Thanks everybody for watching, and we'll see you guys in future videos. Take care.